In venture capital, traction is the clearest proof that a startup is on the right path. It's what separates an idea from an actual business. Investors aren't just looking for exciting concepts. They want to see real evidence of growth, market demand, and financial viability. A startup that demonstrates strong traction signals that it has achieved problem solution fit, is executing effectively, and is on a path to scalable success. Traction isn't just about revenue, it's about momentum. It's about engagement, user behavior, and market validation. Investors evaluate traction by analyzing key performance indicators, financial health, and customer feedback. These are the critical factors that determine whether a startup is truly ready to raise capital and scale. Startups operate in unpredictable, high-risk environments, and many fail simply because they can't attract enough customers, sustain revenue, or scale efficiently. This is where traction becomes a powerful signal for investors. It answers the fundamental questions that determine a startup's potential. Is there real demand for this product? Are customers willing to pay for it? Is the company growing fast enough to justify venture funding? And most importantly, does it have a clear path to sustainable revenue? The stronger the traction, the easier it becomes for founders to raise capital because numbers tell a far more compelling story than words ever could. To assess traction, investors focus on specific key performance indicators that reveal how a company is growing and retaining its customers. While every startup is unique, some metrics are universally important across industries. Revenue growth rate, whether measured month over month or year over year, provides a clear picture of how fast the business is scaling. Similarly, user growth rate indicates whether the startup is successfully expanding its customer base. But growth alone isn't enough. Activation rate, which tracks how many new users meaningfully engage with the product, is a key measure of whether the company is truly delivering value. Beyond growth, investors closely examine engagement and retention metrics. A high customer retention rate suggests that users find long-term value in the product, while a rising churn rate raises concerns about customer satisfaction. Net Promoter Score, NPS, provides another important insight. It measures how likely customers are to recommend the product to others, a strong indicator of customer enthusiasm and organic growth potential. Then comes financial sustainability. Revenue is important, but investors also need to understand whether the business model is built for long-term success. Gross margin, which represents the percentage of revenue left after covering the cost of goods sold, signals profitability potential. Burn rate, the rate at which a startup spends capital, determines how long the company can operate before needing more funding. Runway, the number of months before the company runs out of cash, is a crucial factor in assessing risk. Efficiency metrics further separate strong startups from struggling ones. Customer acquisition cost, CAC, measures how much a startup spends to acquire each new customer, while lifetime value, LTV, estimates how much revenue that customer will generate over time. The ratio between LTV and CAC is one of the most telling signs of a startup's sustainability. If acquiring customers costs too much compared to the revenue they bring in, the company's growth isn't scalable. Traction, however, means little if the company's financial foundation isn't solid. Investors don't just want growth, they want sustainable growth. They look at unit economics to ensure that the business makes more money per customer than it spends acquiring them. They analyze burn rate and runway to determine whether the startup is spending efficiently or simply burning cash without a clear path to profitability. The revenue model is another critical consideration. Businesses with recurring revenue, such as SaaS companies with subscription-based models, tend to be far more attractive to investors because their revenue streams are predictable and stable. A startup that needs to raise capital every year just to survive is in a far weaker position than one that is growing efficiently and managing its resources wisely. But numbers alone don't tell the full story. Investors also look for customer validation, real-world proof that users love and rely on the product. Organic growth is a powerful sign that the product is spreading through word of mouth rather than expensive marketing. When customers actively refer the product to others, it signals deep engagement and trust. Case studies and testimonials provide further evidence of impact, showing how the product is solving real problems for its users. Perhaps the most compelling proof of value is when free users willingly upgrade to paid plans, demonstrating that the product is not just interesting but essential. During the due diligence process, investors often speak directly with customers to gauge their level of enthusiasm. If users express excitement, strong satisfaction, and a clear dependence on the product, it boosts investor confidence. A startup with highly engaged users and organic referrals has an undeniable advantage when raising capital. However, not all traction is equal, and certain red flags can signal trouble. If growth is slow or inconsistent, it raises concerns about whether the company can scale. A high churn rate suggests that customers are trying the product but not sticking around, which could indicate a lack of real value. Burning through cash too quickly without improving key metrics is another major warning sign. It suggests that the company is spending unsustainably and could run out of money before reaching profitability. Over-reliance on paid acquisition can also be a problem. If a startup's growth is entirely dependent on advertising rather than organic or viral adoption, long-term scalability becomes uncertain. Ultimately, venture capital follows traction. A startup with strong key performance indicators, engaged customers, and a financially sustainable model naturally attracts investment. On the other hand, even the most promising idea will struggle to secure funding if there's no clear evidence of real growth and demand. For founders, the best way to raise capital isn't through an impressive pitch deck or fundraising gimmicks. It's through showing undeniable proof that the business is working and growing. Because at the end of the day, in the world of venture capital, traction speaks louder than anything else. In venture capital, traction is the clearest signal that a startup is on the right path. Strong growth, customer retention, and financial sustainability demonstrate a company's ability to scale. Investors analyze key metrics, including revenue growth, CAC/LTV ratio, and customer engagement, to determine if a startup is worth backing. While flashy pitch decks help, the real way to attract funding is through undeniable proof that the business is working, because in VC, traction speaks louder than anything else.